Across the U.S., I think on 83 assets sold to date, we've generated a 26% net IRR to our investors. The portfolio, the Southern California portfolio, which accounts for about half of those, is closer to 30%. So why is that? Why has Southern California been our best performing market? And it's really the reason why we are primarily focused on Southern California right now. The answer simply is because of the dynamics that I described earlier, buying from a fragmented pool of unsophisticated mom and pop owners, and we have this huge cost advantage. There's an asymmetrical risk reward proposition that you can get in Los Angeles that you just simply cannot find in any other US market. And we speak from experience in 30 years of investing nationally in this strategy. So let's look at the upside. The upside in any low cap rate market like Los Angeles can potentially be enormous if you know how to increase cash flow. So for in a 4 cap market, which is generally what exists in Los Angeles and has been that way for a long time, for every dollar of cash flow that you're able to increase, you get a 25-fold increase in value. Huge, huge upside potential. But are there opportunities? Well, the answer to that is yes, because the ownership is fragmented across this huge pool of small mom and pop owners that don't know what they're missing. They don't realize their assets are underperforming, or they do realize it, but they don't care because they're keeping vacancy low, they're keeping their out-of-pocket expense low, and they're keeping their cash flow steady, which is rational. So abundant value-added opportunities in a low cap rate market for a manager like Paladin, who has a track record, 30-year track record across almost $1 billion of assets, increasing cash flow. There are ripe pickings here. Let's talk more importantly, I believe, is downside protection, which in LA is unparalleled in this sector, in this product type of apartments compared to any other US market. Why is that? As I said before, these smaller assets, low density assets are irreplaceable. They would not be feasible to develop today. Further, more importantly, the cost advantage, our all-in cost advantage, purchase price plus renovation budget, is a 50% discount or more to the cost of new construction, even if we were competing directly on a rental basis. So we have a huge cost advantage relative to new construction. You cannot find that discount anywhere else in any other US market where ownership is dominated by sophisticated institutional investors, because they will capture that loss to lease, and the asset prices then will bid higher and get closer and closer. And you don't have the kind of constraints on new supply, high land values, entitlement costs, litigation, all of that create a much higher replacement cost here in Los Angeles compared to others. What I just described is perhaps the most chronically supply constrained market in the US of any type of product type. What it's created is a permanent renter class here in Los Angeles. These are renters by necessity. The prospect of owning a home is unrealistic because of the high cost of housing here relative to incomes. And so they have no other choice but to rent. And that creates a resiliency of demand for Class B, C assets, which is where these renters by necessity live. They perform remarkably well during recession. Occupancy stays stable, sometimes even goes up as people move out of the more expensive Class A space into the more affordable Class B and C spaces that we own. Rents dip. No market is immune. No submarket is immune to market forces and economic forces. And so in the last 2 downturns that we had, one, the recent pandemic downturn, and then the global financial crisis, rents went down in the Class B, C space by about 10%, only to rebound by more than that amount, by 15% within a year or two. So These are among the most cycle resilient assets in terms of demand of any type of real estate in any type of market in the US. And as long as you conservatively capitalize these investments, which we do, and so you make sure that your capital structure allows you to, your cash flow, even if rents come down 10% and occupancies shift a little bit, you can still pay your debt service and you don't have interest rate risk and you don't have loan maturities that are coming due in the middle of a business plan. It's hard to, I don't want to say it's hard to lose money because that's without knocking on wood, but we have yet to lose invested equity here in Los Angeles. It's been one of our most successful markets.